What would be your piece of advice right now for the new stackers, for the new, like, there's so many new people on this channel, and I'm sure on your channel as well, and in the silver and gold markets. What would be your, just your simple piece of guidance for them as this is their first time? We've been here for many years. You've been here for many years in the industry. What would be your guidance for them?
Number one, I think it is critically important for people to understand, no matter what it is they're doing, what's its true value? What is its true fundamental value? Not what Wall Street wants to lie to you with, or governments want to manipulate you with. So that also goes back to the other question at, what's the true fundamental value of an ounce of gold? Well, it's simple. Money's created from debt. And so you just take all the debt in the world and you divide it by all the gold. There's a finite amount of this stuff, and that gets you to somewhere between $38,000 and $40,000 an ounce. So at $5,000 an ounce, it's a bargain. But
Hmm.
that also puts silver at a 20-to-1 ratio, at about 18 to 2,000 an ounce. Why would you sell it when you know that it's really worth at this moment? And the more money they create, the higher those numbers go. They're just numbers.
Right.
Why in the world would you sell it for 100 or 120 or 84 or wherever it happens to be in a trading market at this moment in time? That's what I'm talking about. They don't understand the fundamentals of the markets, but it's really very simple. You just need to be able to determine, how much is this really worth? The Federal Reserve tells you how much this is worth. Go on their FRED and put in purchasing power of the consumer dollar and look at that left-hand axis, and you see a big fat zero. And that means anything you can only convert into this, I don't care how many zeros it has on there, wherever my $10 trillion note went. I don't care how many zeros it has on there. 10 trillion times zero is zero.
Yeah.
So be aware, because you see crypto going up, you see stocks going up, and you think, oh, look at that. It's a bull market. No, 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 that's not the real market. That is just an illusion to keep you in the system so that they can rob you more easily. Because when the market crashes, or they say, no, you can't liquidate, you have no choice. There's no one to talk to. Record debt in richest countries raises alarms because global budgets are strained by borrowing costs. So let's just bring those borrowing costs down so we can borrow more and more and more. Well, there's a real problem with that, and I think we're starting to see that. And you have to ask yourself, has the crisis begun? Because what I'm seeing are a lot of stress signals. And this is extraordinary, and it's a warning sign. Because this past weekend, I looked at it, and it was really interesting. I was looking for what people were searching the most, and millions of people went searching not for entertainment and not even for distraction, but for answers. They were looking for about what was going on with the gold and silver volatility, with crypto crashing, with bank safety, with inflation that won't go away, with the Fed losing control. And quite honestly, the reason why I read this first is because this is where it stems from. Why? Because the system is based on constantly compounding debt. And if you have a problem growing debt, you have a problem growing the fiat currency to stimulate the system. So that's why I brought that up first. But let me show you those signals, because it's showing us that confidence is cracking, and the public, well, we can feel it. Because before a system breaks, we get a warning. Before the markets move, fear moves first. And right now, the world is asking the same question. Is my money safe? But you're talking about your fiat money that's in the system, and I can tell you right now, no, it's not safe. But what they don't realize is that these searches, they're not about the markets at all, really. They're about that first domino to fall, the one that falls really quietly. You can't even see it before the rest fall quite loudly, like we've been seeing over the last couple days. This is when this is when the illusion starts to fade. The moment when systems reveal their weakness. And this is the moment when preparation becomes power. And that's what we have to do. That's what this is all about. My personal goal is to translate this financial noise into understandable language so that you can make educated choices that puts your best interest first. So let's move on so I can show you the first domino to fall was Microsoft. On January 30th, if you haven't noticed this yet, one of the most stable mega caps gapped down 11%. That's actually not normal. That's a collateral event. And you'll see where I did that circle on this slide. That's because the 50-day moving average, which we've been talking about this quite a bit, the 50-day moving average crossed below that 200-day moving average. And that is a technical bear signal. Okay, so look at that gap down, because that then triggered the next piece, which is Bitcoin, which has already been in a bear market. Crypto is always a speculative release valve. So when liquidity tightens, it goes and drains there first. And when confidence evaporates, well, frankly, utility matters. And in a crisis, the world turns to certainty, not speculation. And why does that matter? Because what we're looking at are contracts. And contracts are used in one place. Bitcoin or cryptos or other speculative intangible assets, again, one place, 33 places, 36 places. So when demand goes away, guess what? They can and they do go to zero. It's confidence that gives it value. Just like fiat currency, just like this stuff. It's your confidence that this is something real, that this is something that has value, that pushes you to use it and be willing to work for it and try and save it. But quite honestly, that brings us to the canary in the coal mine. Because, all right, sorry about that. I'm a little ahead of myself here. But I want you to look at the spot Bitcoin, because we've been talking about the 200-day moving average. You can see the same kind of crossover that you see right there. So what you need to know is that that 50-day moving average currently, the spot price, is 13.73% away from that 200-day moving, or from that 50-day moving average. And I did these on Friday, so they're probably a little bit different today, but it proves the point and makes the point of what we're talking about here. That 200-day moving average, 26% away from that 200-day moving average. Remember, 10% is a lot. Can we have a dead cat bounce? Yes, we can. That's all that it will be about. It doesn't mean that anything has actually changed in there. But what about, oh yeah, look at this. I pulled this morning. That's why I'm a little off on remembering what's even in here. But crypto exchanges buckle as stock losses top 55% on the retail exodus. Retail exodus, one place. You see what I'm saying? When demand goes away, if you've got everything in one place, you've got nothing. Further than that, this I'm going to have to read hard because it came up this morning. Get me out. Traders are exiting a lot of their positions in artificial intelligence, right? So can you see how one thing, it's a domino effect, and when one thing goes down, it implicates other things as well. But here, gold and silver are the canary in the coal mine, and the canary is screaming because it's about the paper market cracking. I love this slide, and I had to use this slide because what does it say? This doesn't seem like a store of value. How are we supposed to trade this? Gold and silver are not a trade. The paper market's whipsawing 200 points one way or the other. That is about a trade and paper, and it's a trading market. The physical market is way different. It doesn't move that fast. It can't move that fast. And volatility in metals isn't really about the metals. It's about that paper market cracking. And when the derivative structure wobbles, and remember, derivative is just a big unsubstantiated bet. You can't convert it into the underlying. But when the derivative structure wobbles, it's this physical market that reveals the truth. Volatility is not risk. Counterparty exposure is that risk. And the physical market, well, it's told in a very different way, and it's showing a different story that started in 2025, right? When we were transitioning away from the paper markets into the physical markets dictating everything. Gold's record run in 2025 was not speculative. It was structural. We've talked about it throughout the year. Jewelry volumes fell 18% because prices rose, but spending hit $172 billion. Consumers did not walk away. They shifted how they buy gold. China is a great case in point, and so is India, because people move from jewelry to bars, coins, and even ETFs, which is not gold. That's what Wall Street wants you in because they can still control it. But the physical metal in your possession in any way, that's gold really returning to its monetary roots. But we also saw a massive east to west divergence. Western investors, like here in the US, they bought ETFs, while Asian buyers, especially in China, they bought the physical metal. Well, that's because the US has been used to those contracts dictating price. But what we're seeing is that breaking down. China's bar and coin demand broke the 2013 record for the first time ever. You saw bar and coin demand surpass jewelry consumption. So the question was, did I miss the trade, right? Because it went up so fast? That's not really the question. What role does gold play in my portfolio? And it's as a stabilizing force, because that shift didn't start with consumers. It started with central banks, the quiet accumulators. And you can see, I want to point something out to you, and I will be updating this chart. I just got all the data from it for 2025. So this actually goes through 2024. But from 1990 to 2000, central banks sold and leased and did all sorts of funny things to suppress the visible price. But by 2005, that course was reversed. And by 2010, they were net buyers. I'll point out that 2005 was 3 years before it became obvious to you that there was a problem. But central bankers knew it back then. And today, they're buying more gold than at any time in modern history. So let me show you what that looks like. Because what you're looking at here are a bunch of central banks, and those blue lines, 22 institutions reported an increase in their gold reserves around a ton or more during 2025. And you already saw how much they've been accumulating. And yet, like I said earlier, demand actually set a fourth quarter record, but a lot of that demand actually came from the public. So the public is noticing that there is a problem here. ETFs inflows, well, I think that this is interesting because this is one way that Wall Street can control the visible price, because an ETF, all you have is a share of a trust. And the underlying gold and or silver that supports that, you have no access to. But Wall Street can decide to buy the ETF and push the spot price up, or sell the ETFs and push the spot price down. It's a tool. However, what I liked the best was a 12-year high in bar and coin buying, because that's the public. So the central banks kicked this off. They've been buying since 2005, but the public is now transitioning. And I like that so much, because really, silver is the warning. Silver, and here it was. This was the beginning of January. Silver is now a strong buy, the highest lease rates since 2008. So what we're seeing here is the cost to borrow silver or to lease silver in times of stress spikes. And the timing of these spikes tell this story, because short-term silver lease rates hit their highest level since 2008, and both of these levels, which were in October of 2025 and then just recently, both of them are significantly higher than the lease rate premiums in 2008. What is that telling you? They want you to think everything is hunky-dory, that everything is just fine. But silver is the fuse. And what silver is telling you, even in these paper contracts, is that confidence is declining. And this is tremendous for you to know, because when confidence falls, well, what do? Exchanges intervene. And let's see, here it is. Market intervention. Surging silver and gold slide after the CME, and I did a video on this, raises margin requirements, which means that you have to come up with more collateral to borrow, which both of these, between the lease rates and the margin rates, that makes it more expensive to speculate. When you have the physical metal in your possession, you're not speculating. You're holding something with no counterparty risk. But all of this other stuff runs tons and tons of counterparty risk. So it was in, and this is really important, December 20, let's see, I think that's 29th of 2025 was when they did their first margin hike, triggering an immediate sell-off. Silver fell about 8% and gold about 5% on that Monday after they raised the rates. But that wasn't enough. Why not? Because guess what? They did it again on December 30th to the 31st. They raised the margin rates again, and again in January, just recently, on the 31st again. 3 hikes in 1 year. The first one alone was massive. 33% for gold and 36% increase for silver. That's massive. And the CME rarely raises margins twice in 1 week, unless that volatility is extreme and they are extraordinarily vulnerable. This, the 29th, the 30th, and 31st, this was a double hike event. What does that tell you? Because that tells me panic. That's what that's telling me, and that's what it should be telling you, because we've been talking about it all year. This shift is not completed yet, but I think we're at a very interesting part of this shift, and the shift I'm referring to is the physical metals dictating the markets, because we've certainly seen the premiums and talked about the premiums to buy the metal in other parts of the world, right? And the market reacted exactly as you would expect. What happened? Oh, I want to show you this too. This is from the FDIC's most current, so third quarter of 2025, gold and silver derivatives in the FDIC insured banks. And I circled 2025 so you could see how much more banks were trading gold and silver. Contracts, not the physical, the contracts. So that is an easy way for them to actually control the price that you see. And here's the market reaction. And actually, I noticed that one of the questions was about support and resistance. But on Friday, you saw silver make a major dumperooski, right? Now, let's go over the terms that we've been talking about for quite some time, because Friday's drop didn't change that trend. And actually, any of the drops, well, today, everything is spiking up. But yesterday, there was even another drop in spot gold contract. But even that did not take it out of that overbought position. Remember, we've talked about this right along. Remember, that does not mean overvalued. But overvalued means that the fundamentals don't justify the price, but that's not really what's happening right now. The fundamentals are very solid in both gold and silver. So let's take a look at it, because on that particular day, spot silver, and there's your 50-day moving average that we talk about, and there's the 200-day moving average that we talk about. So where are they? Well, at the end of Friday, you still had the 50-day moving average at almost 15% and the 200-day moving average at 75%, keeping in mind that 10% is a lot. I don't really care if it pulls back. It is a contract, and it does not reflect the true fundamental value of an ounce of silver, which is somewhere around $1,800 to $2,000. It's a bargain at these levels. Well, let's take a look at spot gold. Here you go. Spot gold is the anchor. Here's your spot gold, your 50-day moving average, and your 200-day moving average. Where are we at? We're still almost 10% away above the 50-day moving average. Now, I think it crossed it yesterday, but it went back above it today. And now at the 200-day moving average is still over 29% away from that 200-day moving average. So knowing the truth can help you make educated choices. You're looking at paper markets here. But keep in mind that we are transitioning into the physical markets dictating the price. And I am very happy about that, because it's about darn time. So with that said, together we can change the world. Let's just do it. What the hey? What the hey? Imagine if we actually get redeemable gold back in the system, our great grandchildren will thank us for it.